Hello and welcome to our channel, where we dive deep into financial education. Today, we're going to explore everything you need to know about the stock market, how it works, why it's important, and how you can participate. Whether you're a beginner or looking to deepen your understanding, this is your complete guide to the stock market. The stock market is a vast, complex system where shares of publicly traded companies are bought, sold, and traded. These shares represent ownership in a company, giving investors a stake in its success or failure. But why do companies offer their shares to the public? The stock market allows businesses to raise capital from investors. In return, those investors own a piece of the company and have the chance to earn profits. Most trades happen electronically, and the prices of shares fluctuate based on supply and demand. This is the basic law of the market. When more investors want to buy a stock, its price goes up. If more people want to sell, the price falls. In simple terms, buy low, sell high is the goal. But what exactly makes stock prices rise or fall? We'll get into that shortly. First, let's break down the two types of investors in the market. There are two main types of participants in the stock market: investors and traders. Investors are in it for the long game. They buy stocks and hold on to them for months or even years, expecting the company to grow, and with it, their portfolio. They look at the company's fundamentals, its financial health, market position, and growth potential. Traders, on the other hand, buy and sell stocks quickly, sometimes holding on to them for just minutes or hours. They rely on short-term market fluctuations, using technical analysis to predict price movements and maximize profit. While trading can lead to fast returns, it also comes with higher risks compared to long-term investing. Now that we know who's involved, let's move on to where all this buying and selling happens. The stock market consists of various stock exchanges, such as the New York Stock Exchange, NYSE, and the Nasdaq. These exchanges provide a platform where buyers and sellers come together to trade shares. Think of exchanges as a marketplace, an organized and regulated place where stocks and other securities are bought and sold. However, most trading today is done electronically, making it easier for investors around the world to participate in the market from their computers or phones. Besides the well-known stock exchanges, there's also the over-the-counter market, OTC, where smaller or less regulated companies trade stocks. While OTC trading is more flexible, it also comes with greater risk due to the lack of transparency. So, how do companies get listed on a stock exchange? To go public, a company must conduct an initial public offering, IPO. This is when a company offers its shares to the public for the first time, raising capital from investors. Once the IPO is complete, the company's shares are traded in what's called the secondary market, which is essentially the stock market as we know it. From then on, the stock's price fluctuates based on investor demand, economic conditions, and company performance. Companies must meet strict financial reporting regulations to remain publicly traded, providing transparency to investors. These regulations are enforced by government agencies like the Securities and Exchange Commission (SEC) in the U.S. Stock prices are determined by several factors, both fundamental and technical. Fundamental factors include the company's financial health, earnings, profitability, and how well it performs in the industry. Investors analyze these metrics to assess whether a company's stock is worth buying. Technical factors focus on market trends, charts, and historical price movements. Traders use technical analysis to predict how a stock will perform in the short term. Supply and demand play a significant role too. For example, if a company reports strong earnings, more investors may want to buy its stock, increasing the price. On the flip side, negative news or poor earnings could drive the price down. People invest in the stock market for various reasons. Dividends. Some investors hold onto stocks for the income from dividends, which are regular payments that companies make to their shareholders. Capital gains. Others buy stocks, hoping the price will increase, allowing them to sell at a higher price later. Ownership and voting rights. When you own stock, you get a say in how the company is run. Shareholders vote on important decisions, depending on the number of shares they hold. Investing in stocks offers the potential for long-term growth, and historically, the stock market has outpaced inflation over the long term. Market indexes like the Dow Jones Industrial Average, DJIA, or the S&P 500 serve as a snapshot of the overall market's performance. The Dow Jones tracks 30 large U.S. companies, giving us a quick look at how major corporations are performing. The S&P 500 tracks 500 of the largest U.S. companies, providing a broader view of the market. These indexes are crucial because they serve as benchmarks. Investors use them to measure their portfolio's performance against the overall market. If you're investing in tech stocks, you might compare them to a tech sector index. It's not just stocks being traded in the market. Other assets include bonds, debt securities issued by governments or corporations. Bonds are generally safer than stocks but offer lower returns. Mutual funds and ETFs. These pool money from many investors to buy a basket of stocks or bonds, providing a diversified portfolio. Real estate investment trusts. These allow investors to buy shares in companies that own and manage real estate properties. Derivatives. Options and futures contracts whose value is based on underlying assets like stocks or commodities. To trade stocks, you need a broker, a licensed intermediary who executes trades on your behalf. There are two main types of brokers. Full-service brokers. They provide comprehensive financial advice and portfolio management. Discount brokers. They offer lower fees but expect you to make your own investment decisions. Online platforms have made trading more accessible than ever. Today, you can trade from your phone using apps like Robinhood or Webull, often with no commissions. The stock market is regulated to ensure fairness, transparency, and investor protection. In the U.S., the Securities and Exchange Commission enforces laws against insider trading and fraud, while overseeing the stock exchanges, brokers, and publicly traded companies. Globally, different regulatory bodies ensure fair trading practices to maintain investor confidence in the market. The stock market plays a critical role in the economy. It enables companies to raise capital, investors to build wealth, and governments to foster innovation through investments. Understanding how the stock market works is the first step to becoming a smart investor. Thank you for watching. If you found this guide helpful, make sure to like, subscribe, and hit the notification bell so you never miss a financial tip. Drop a comment below with your thoughts or questions, and we'll see you in the next video.